Hello and welcome to our commodities podcast. I'm Ravindra Rao from Kotak Securities Commodity Research Desk, and as always, we will highlight key developments to keep an eye on the current week. Last week witnessed a notable shift in market sentiments, suggesting that traders are beginning to see signs of improvement. The impact of the Federal Reserve's tightening measures appears to be taking shape, and the rollout of fresh stimulus measures in China has captured the attention of investors. The eagerly anticipated US Nonfarm Payrolls report presented a mixed picture last week. While payrolls expanded by 1,87,000 in August, surpassing the estimate of 1,70,000, indicating resilience in the labor market. However, other aspects were less rosy. Average hourly earnings showed modest growth, and the unemployment rate unexpectedly rose to highest rate since February 2022. Overall, the data pointed to a labor market that remains tight, supporting a recovery in the US dollar from lower levels. During the previous week, the US dollar largely traded on a negative trajectory in line with mostly softer US economic data. Key economic indicators such as US jobs, job opening, a measure of labor demand, and private employment data revealed some weakness. Moreover, US core PCE, the Fed's preferred gauge of inflation, increased by 0.2% month on month and 4.2% year on year in July 2023, aligning with the market expectations. Meanwhile, the second quarter GDP was revised lower, although personal spending saw a significant increase, surpassing forecasts and indicating consumer resilience. Coming to commodity specific, COMEX Gold surged to a 3 week high of $1980.2 per troy ounce as the dollar initially slipped to 102.93, and the US 10-year yields extended their pullback from 16-year highs reached earlier in the week. This shift in gold prices was driven by increasing odds of Federal Reserve nearing the end of its tightening cycle. Bet on the Fed leaving rates unchanged in September rose about 90% from up from 80% in the previous week. Furthermore, the odds of a rate pause in November and December has climbed to nearly 60%, according to the CME Group's Fed Watch tool. In terms of investment demand, holdings in SPDR Gold ETF rose from 884.04 tons in the previous week to 890.10 ton as of August 31st. Robust economic data from the US in the first half of August had prompted markets to price in further rate hikes by Fed, leading to higher yields and outflows from ETFs. However, this trend is gradually reversing. On the price action front, dollar index has been quite volatile in the previous week. It came to as low as 102.93, but recovered later in the week and closed above 104 zone. Resistance in dollar index is placed near 104.65, which is May 2023 highs from where it had corrected till the recent low of 99.75. So that would act as a stiff resistance, and on the lower side, 103.1 to 103.05 is the 200-day moving average, which would act as a support. So we expect the price to trade between this range. A break below 103.04 on a closing basis might turn it further weak. Otherwise, some consolidation might set in. In case of gold, spot gold has moved up to 1945 per troy ounce, and it has taken support of the 60-day moving average at around 1930 and is trading higher. The next level that the bulls might be looking at is 1984, which is almost $40 away from here. And the initial level that the bulls might be targeting to break is 1952, $1953. If that is taken out, then 1984 would be very much possible. On the lower side, as I mentioned, 1930 would act as a good support, and strong support is near the 200-day moving average of $1916. Gold is slowly and steadily moving higher, but we need to see how the data shape up in this week, and that might set the direction for gold prices. In case of silver has once again taken resistance near 25.50 and has corrected. Uh, on the lower side, immediate support is near 24.40, and strong support is near 23.80, which is the 60-day moving average resistance. The bulls will have to take out 25.50 dollar for it to sustain on the higher side. If that happens, then we might see some recent highs being broken in silver prices. So watch out for 25.50 on the higher side, and on the lower side, 23.80 would be good support. In case of crude oil, prices ended a 2 week losing streak, posting their most significant weekly gain since April with a 7.5% increase. This rally was attributed to Russia's indication that it would extend export curbs, along with a massive draw of 10.6 million barrels uh, in US crude oil inventories for the week ending August 25th. This drop pushed total stocks to 422.9 million barrels, their lowest level since December 30th. On charts, NYMEX crude oil has penetrated a very stiff resistance of 83.80 and has given a very good weekly close above $85. Uh, this is a positive indication. However, for a confirmation, if it gives a daily close above $86.06, then it might confirm, and the prices might move on to hit $90 per barrel. But if that doesn't happen, then some corrective move towards 83.80, $83 is possible, which might once again attract buying, as that has become the support, which was earlier the resistance, and strong support is near $79, below which this pattern might negate. Finally, base metals also experienced a sharp rally as investors assessed China's latest stimulus measures and the possibility that the worst of China's factory slowdown may be coming to an end. China's official manufacturing PMI showed a slight improvement to 49.7 in August, although it remained in contraction territory. China's efforts to boost its equity, currency, and property market succeeded in calming some investor nerves. Looking ahead to this week, the focus will be on the U.S. ISM Services PMI. Subsequently, U.S. CPI and retail sales data will be released, which are three major indicators that could impact Fed policy expectation for the September meeting. This will be in the following week. China impressed the market last week by allowing some of its largest cities to reduce down payments for home buyers and encouraging lenders to lower rates on existing mortgages and deposits. Additionally, China reduced the foreign exchange reserve requirement ratio for financial institutions and trimmed stamp duty on stock trades. Having said that, China's plan of action to boost its economy may dictate the market direction for the week. Well, maintaining a key awareness of global events is essential for making astute trading decisions. If you have any inquiries or suggestions for our podcast, please don't hesitate to get in touch. We appreciate your listenership, and may your trading endeavors be prosperous and rewarding. Thank you for tuning in.